All right. I see that there's a classroom out there. Let us go bring the classroom in here.
Oh, okay.
Hey, Dinar.
Hey.
Mr. Glassy, how are you?
Hey, Dr. Dorset. I'm fine. How are you?
Good.
Good. Are we okay to go, or do you want to wait a few more minutes and get everyone set up?
Why don't we give it about 5 minutes?
Beautiful. I'll turn my mic off, and I'll put the slide back on. I'll see you back here in about 5 minutes.
Okay, sounds good.
Thank you.
Okay, we can get started.
All right. Well, I'm just going to say hello to California. I'm Alex Glassy, and I am up here in lovely Victoria, Canada. I want to just thank you, Dr. Dorsett, Rob Kirkland, and the school, and in particular the class here of MBA candidates for inviting me to come and spend this next half an hour, 45 minutes with you. I'm really enjoying it. Coincidentally, I was actually down in California about 30 miles away when I got the phone call from Rob asking me whether I could come in and speak. And I thought he meant that day. And I would have been delighted to come and speak to you in person, but I think this is the next best step. So I'm going to put up my slide deck right now. I've got about a half an hour or so, maybe a bit more. I hope, is that okay, Dr. Dorsett?
Yes, that's fine.
Okay, perfect. And then I'm happy to stick around as long as there are questions, and happy to answer them. And as well, just so the class knows, there is an international audience of people who are also watching this lecture. Now, this is your day, and so I'm not going to bring them in, but just so you know, the technology we're using is allowing people right now from, from my hometown, but also from New Zealand and other countries that are also watching this lecture. So without further ado, let me get right into this. So a little bit about background about who I am. As I said, my name is Alex Glassy. I'm the husband to Renata, the father of Keyomi and Lewis. I'm a serial business owner. There's a business that I'm involved with right now, which is the technology that we're using called face-to-face, or F2F. So that's number 6. That's the 6th business I've created. Between my second and third businesses, I was able to go and spend some money and some time and get an MBA down in the United States at Kellogg. So I've got that, and that was my initial exposure formally to corporate finance. I'm an entrepreneurship prof up here in Canada. I teach entrepreneurship to engineers, but I spend most of my time as a business owner advisor, or an advisor to business owners around the world through my software and lessons and lectures and that type of thing. That's a little bit about who I am. This is what I do when I'm not lecturing and working. Is I like to get out on a boat to the extent that I can, and I find that things that I do on a boat, carefully looking ahead, trying to figure out where I'm going, charting the course, checking the weather, all those things, they're very, very good practice for running a business. That's for sure. Oh, and here, just to show you on a map of where I'm at. So I'm up here in Victoria, which is just northwest of Seattle, and you're way down here, almost 2,000 kilometers, or about, I think it's 1,200 miles by car. And here's Google telling us that it's only $263 to fly to get down there. So we're a long way away from each other, but directly north. So just to get everyone on the same page, and again, I'm not an expert on corporate finance, Dr. Dorsett, that's your specialty, but just to get everyone on the same page, this slide says corporate finance seeks to maximize shareholder value. And it does this by making decisions on essentially 3 things: the sources of capital, where the money comes from, how we're going to structure that capital, and it could be as simple as just debt versus equity. But again, there's a lot of nuance and a lot of depth to that. By the way, the chief financial officer of Apple, because of his skills in getting and structuring and allocating capital, is worth well over $100 million. So corporate finance is a good place to be. And then, of course, once we have the money and it's structured, then we have to allocate it. So here's an example, highly simplistic, but we've got some capital from the bank. We're going to structure it as debt, and then we have to allocate capital, and we take a look at the various projects that are in front of us, and we choose the one that's going to give us, when all things are considered, the best return. And so in this particular case, we would choose, if we only had money for one project, we would choose project A, which is going to give us 12.4% return rather than 11.3%, right? So again, highly simplistic, but we're on the side of the angels because what we're trying to do is to maximize our shareholder value. And this is a good thing. You can see this play out in all kinds of businesses. So I'm going to take a company that some of you may well know. In fact, it's a company that everybody used to know. Kodak started in 1888, way back here. They started with some basic technology, and then they grew the company. In 1930, they were added to the Dow Jones Industrial Index, and they stayed on that index for the next 74 years. They were a real pillar of American and the world's capital and investment decisions. And they grew their business and grew it and grew it and grew it until their peak in 1997 here, where they had almost $2 billion in cash. They commanded 2/3 of their global market share, and they were worth over $31 billion. So again, as the decisions were being made, as corporate finance was involved in driving Kodak forward, they did their job really, really, really well, and shareholder value was increased enormously over this time frame. However, as we know, the story isn't necessarily all good, because after that peak in 1997, their stock value declined over the next 15 years until the company went bankrupt. Now, the responsibility isn't entirely corporate finance, but clearly we can see that some bad bets were made or some good bets were missed. And I think it's probably the latter. I think it's probably that some good bets were missed as it went along. And it is foreseeable, because as part of your MBA, you're going to be introduced to something called an industry S-curve, and it actually predicted Kodak's eventual demise. What the industry S-curve says is that an industry, when it starts off, or a company, when it starts off, goes through some very predictable phases. These phases start off with introduction, just getting going, and then growth. We can talk about this in a minute, but fast growth, and then it starts to mature. The industry and or the company starts to mature as the early opportunities are not quite as easy to find and not quite as lucrative. This maturity then turns into decline. And so as MBAs, not only are we taught this capital financing and how to grow shareholder value, but at the same breath, we're also taught that there's a decline to these things, and it's almost to be expected. So these things kind of fight each other. And the reason that this happens, the reason that corporate finance can only take us so far, is that in there's an inherent assumption about the rational economic behavior on the part of the actors on the market. That's what corporate finance says. It says we are going to learn all that we can about our marketplace, our sources of finance, our customers, how we deploy resources into the marketplace, and we're going to create better and more refined tools as we learn about our company, as we learn about our industry. We get into this mode of incrementalism. We've got a bunch of projects coming at us, 12.4%, 11.3, 10.9, 13.8, and we make our decisions based on those projects that are coming at us. And corporate finance is very, very good at that. What it's not good at is disruption or discontinuous thinking. And that's the essence of innovation. Innovation is defined as the introduction of something new. And these things, they seem to not live well together. They seem to be very, very different. And yet, let me just keep going here. And so, corporate finance on the one hand takes a look at these projects, knows what it's supposed to do here, but has a real hard time trying to figure out what to do with a project like this, a project that's got very, very high risk, a project that has potentially very, very high rewards. It looks foreign to us, in particular if we've been used to this incremental approach and having a refined set of tools. In fact, when we try to plug in a project like this into our tool set, we end up with weird values that it's zero or it's infinity, or we get negative values. And these, trying to go into a boardroom and advocate for a particular project when it has a negative return or a zero return, in other words, we're not going to make money or we're going to lose money. No, those are career killers. We're not going to do that. At the same time, going into a boardroom and saying that, listen, I think this project has a 1 billion% return, that just, you're going to get laughed at. So that doesn't feel very comfortable to us either. And yet, we have to figure out a way to reconcile these things. So these two mindsets, this corporate finance mindset and this innovation mindset, I want to take you back to 2003 when there were two companies that had created very similar technology. One of them was YouTube, one of them was Vimeo. And what they realized back then, the internet was still very young. What they realized is that people were looking for a way to push video up onto the internet, and they were also looking for a way to watch video, take video down off the internet. And so they both created similar technologies that were able to do this, and both of them very, very well, except that they both had different mindsets. Vimeo had a traditional mindset. They were part of an existing company, and that was doing very nicely, thank you very much, and generating good revenues. And so when this company created Vimeo, it needed to protect what it already had. It needed to protect it. And so it made decisions based on what's I would call the traditional way of thinking. Whereas YouTube was a brand new company, it didn't have anything to protect. It wanted to get out there and make a name for itself. And so here's what happened. Here's the way they structured themselves. Vimeo went out there as a paid product, a paid service. And after all, that is traditional thinking. You drive revenues by charging people a price for your good or service. So that's how we do that. YouTube said, well, no, we're not going to do that. We want to eliminate the barriers to use. And so we're just going to let anybody do that. So it's going to be completely free. Vimeo also was worried, their parent company was worried about getting sued over copyright violations. And so they placed restrictions onto the type and the length of videos that could be put up onto their platform. The shorter the videos, the less likely it was that someone was going to put up copyright material, and then the less likelihood that they were going to get sued, and therefore the less likelihood that they were going to endanger the existing business and its cash flows. YouTube didn't care. They said there's absolutely no restrictions. Anyone can put up anything at any time for free. Now we fast forward to today, and YouTube takes up 17.9% of the internet activity that's going on every day, 17.9%, whereas Vimeo only takes up 0.11%. This is 163 multiple difference. And we don't know what the value of these two companies are. Vimeo is now part of another organization, as is YouTube. YouTube was bought by Google and is now part of Alphabet. But there's a company called Worth of Web that does its best. And it says that listen, if YouTube would probably be worth about $103 billion and Vimeo is worth $1 billion. This is the difference between traditional thinking, protective thinking, let's make sure that we move forward incrementally, and YouTube, which is innovative thinking, step value, making huge step value thinking. This is the difference in the potential returns that can come from that. And quite frankly, YouTube, some of you may know this story already, 20 months after they started, YouTube was acquired. The three founders sold their company to Google for $1.65 billion, 20-month-old company. So there's a difference between these two mindsets. Now, what I want to start to do is to start to see whether we can't bring these two mindsets together. And of course, Apple is a good example. Apple may be able to show us how interlocking S-curve. Remember that industry S-curve. Interlocking S-curves can delay the inevitable. And bring this back up again. So Apple really has been four companies, or is four companies. It started off back in the day with computers, and it ran that business for a long time with the hiccup, some hiccups and everything else. But they was turned out to grow a strong business. What they then did is they used innovation to get into the music business. Now, their innovation wasn't in inventing something brand new. Other companies had the same types of technologies that Apple had. Apple's innovation was in process and design. And so they created something that started to, it doesn't show it here in the curve, but we will see in another slide. It starts to accelerate or lays the groundwork for an acceleration of their business. Meanwhile, in and around this time, other computer companies are literally going out of business because hardware margins are eroding. The whole industry that was maturing and declining, right? Apple's business was still going strong. And then, of course, they created the phone, and then, of course, they created the iPad. And if I zoom in here, you can see the share value going up here. I'll click in there. Here's their revenue. Let me blow that up for you. So here's their stacked revenue for the period of 2006 to 2012. And you can see that at the very beginning stages here, we've got the iPod and we got the computers, the green and the red. And then in 2007, we've got the iPhone business starts up and really bumps up their revenues, doubles their revenues within a couple of years. Then the iPad came into being, and within the first year, they sold $15 billion worth of iPads. So there's innovation layered on top of their existing company. And then the brilliance of what Apple has been able to do was then to take those discrete and separate businesses and integrate them in a way that they support each other. But when you go onto one product, you're introduced to services and from the other products and products from the other areas of their company. I did find about half an hour ago an update to this particular slide, which is more current, up into 2017, and it just shows all the graphs, continue to increase. In particular, their service business. Their service business is absolutely growing like gangbusters. And so what's happened is with this innovation layered on top of, again, the corporate finance. I'm going to come back to that in just a sec. This has been Apple's stock price, not without its challenges, but on the way to $1 trillion worth of shareholder value. That would be, I think it's it would be the first company to top $1 trillion if it gets there. So what we're seeing here, what we saw with Vimeo was traditional thinking by itself, and what we saw with YouTube was innovative thinking, by itself. What we see with Apple is an integration of those two, where Apple's going, hey, listen, we can't just be a computer company. We need to, and make the little innovations there. We need to create some corporate level innovations, and that means making bets. That means allocating capital. That means bringing the corporate finance people into the room at a strategic level. And I think Apple has done that very, very well. Now, to take it one step further, and how to incorporate, not just a series of macro innovations, I'd like to introduce you to a company called the Minnesota Mining and Manufacturing Company, or the 3M Company. And what they've done is they've embedded innovation at the heart of their business. This is a 115-year-old manufacturing company. They have 55,000 products. In fact, if you were to take one of Apple's iPhones, many of the components of that are actually designed and made by the 3M Company. And so it's not just that they have that they're old and that they've got a large number of products. It's how they got there and how they embedded innovation into the heart of what they're doing. And the way that they did that is they actually integrated a metric, an innovation metric, into the heart of their corporate finance. And that metric is called the New Product Vitality Index. And this New Product Vitality Index tells them the percentage of today's revenue that came from businesses, from products that didn't exist 5 years ago. The new product, I'm going to say that again, the new product vitality index is the percentage of today's revenue that came from products that didn't exist 5 years ago. In other words, they had to invent it. If you flip that on its head and you look forward, what that means is that 34% of their revenues 5 years from now, they have to invent. They have to invent that product. And so this number in 2012 was 34%. The company at that time was spending 5% of their gross revenues on R&D. And their CEO was just about to ramp that up to 6%, which is a 20% increase in R&D spending. And their expectation was that by 2017, their new product vitality index would go from 34% to 40%. This is astounding. I don't know of any other company that knows that they're building their own road, their own pathway, not only into the future they can keep operating, but they're actually building their own pathway so that they can continue to grow at a significant rate. And this is the result of that. This is the stock price of the 3M company going back from 1978 or 77, and you can see it looks very similar in its shape to Apple's stock. Okay, so where does innovation's power come from? I'm just going to move us off the screen here. Where does innovation's power come from? Well, innovation by its nature means unique, and unique means monopoly, and monopoly means that we have reduced price pressure. So imagine if you were the only ice cream store in a 10-mile radius on a hot summer day. If you had a small monopoly on ice cream in Southern California on a hot day, you would be able to raise your price just about as high as you wanted to go, and that allows you to create more gross margins, and those gross margins allow you to the corporate finance people to make, you have more money now in which to invest on all manner of other projects. So that's the key, that's the heart of what innovation does. Let's graph that for you, and I'm going to put the cameras back on. Let's graph it. So here's the graph of the degree of innovation, which corresponds very closely to our ability to set the price. Why does this curve go down? Well, the curve goes down because as we come into the marketplace, as we prove our ability to generate revenue and profits, our competition, like sharks to blood, swarm into the marketplace, and as the number of competitors comes in and as their quality of their products increases and matches ours, our ability to set the price drops. Therefore, our pricing and our margins drop, and the degree of the competition goes up. Now, the interesting thing about these curves is that it almost exactly explains the industry S-curve, right? If you just innovated once, if you had one product or service that you innovated on, this is what the life of your company would look like. You would have the ability to set your price high. You would, at the beginning, and then as your competitors would come in, and you would grow quickly, right? You would grow quickly, right? That's what high price allows you to do, is it allows you to spend money on customer acquisition, on marketing and sales. You grow, but as you're growing, other companies are coming into the marketplace. Your margin is starting to reduce. They're starting to grab customers. You're now starting to compete for customers, and your business, as your innovation comes to an end in a year or 5 or 20, so too does your company. And you can see that the only solution then is to be able to add another big innovation in 5 years or 10 years like Apple did, or like 3M, let's get into continuous innovation. Let's continue to make new products and new services, right? Like Post-it notes, for example, that everybody now uses. So here's 5 specific reasons why innovation drives shareholder value. So the first thing is, we already talked about, innovation creates differentiation, and that differentiation allows for increased margins, fresh marketing, and an invigorated brand. So we've already talked about that. The second thing is that innovation extends the life of existing products. It makes them smarter, faster, lighter, stronger, more fuel efficient, etc. So you can think about the the iPhone. Again, I don't want to keep going back to Apple's products, but we all know it, right? The iPhone, it just keeps getting better, faster, smarter, stronger, and in a fiercely competitive area. Innovation opens new opportunities and new markets. So again, 2 weeks before Steve Jobs released and Apple released their new iPad, the press, the technology press, was making fun of this person and this company massively. They knew that there was this kind of big, oversized tablet going to be coming, and they were merciless in ridiculing it. And yet, a week after the release, when the customers had swarmed onto this product and were driving an enormous amount of sales, $15 billion worth of revenues in the first year, and I think they doubled or tripled that in the second year, right? All of a sudden, things are changing. So that's what innovation does, is it opens up new markets and new opportunities. The Apple example is extreme for sure, but it happens time and time again, right? And just it makes sense. A fresh approach is the best way to get a new customer's attention and edge out a competitor, especially when they can't match your offering. Yep. We talked about that. Innovation leverages existing customer and supplier relationships, right? People always prefer to deal with a trusted partner rather than somebody new. So if you've got a partnership, a supply chain that is used to delivering products to you in a certain way and getting paid in a certain way, and they know what you're looking for and what you right, and you come up with another product, you're extending their business. Your innovation is increasing the revenue for your supply chain. And so, and of course, they already know you, they already trust you, and now they're just going to fit you in to their way of doing things. Innovation's benefits are often felt beyond a single project. So once you have this culture of innovation, when you're in an exciting place to be in this particular project, it has a spillover effect that touches human resources. For example, people will want to come and work for you. Silicon Valley is a classic example of this. When hot companies, engineers come knocking on their door. They want to drive, they want to come there, they want to be a part of this excitement, they want to be a part of the stock options as well, because their innovation and the decisions that are being made are going to drive up shareholder value. But as soon as that company looks like it's past its best before date, then they leave there and they're going on to somebody else. So that's just one example of how innovation actually raises the tide of not just that particular project in that particular group in the lab, but it starts to drive everything, and it's felt beyond the company. The other thing here is that the bonus reason is that innovation doesn't only apply to products. It can be found everywhere. If you think back to Apple's release of the iPhone, granted it was an innovation product. There was nothing else like it. But the reason for its success, another reason for its success and for its cash flow success, was that it wasn't sold like traditional products. Traditional phones at that time were basically leased from the company. The company's cash flow, they got the value of the phone over the 2-year contract or the 3-year contract of the customer who purchased it. But what Apple did is they put the phone up for distribution bids. They chose, I think it was AT&T at the time, and AT&T was granted the exclusive ability to sell phones. But as soon as a phone was sold, as soon as AT&T sold a phone to one of their customers, they had to give Apple the full value of the phone, the full $600 or whatever Apple's price was on that particular phone right then and there. And so what Apple did is they passed the financing burden from themselves, they passed it back to the distribution channel. And in so doing, what they did is, think about that from a corporate finance perspective. It's just brilliant. If you can get someone to pay you ahead of time pay you up front rather than having to wait 2 years for your money. And with all the risk that entails, that then leverages your ability to innovate more, to acquire more customers, to drive up the value of your business, right? I think about Tesla, a recent example. Tesla in their Model 3 series, when they went to their customer base and they said, you can put down a deposit on a Model 3 ahead of time, and for $1,000, it's only $1,000, and 400,000 people have taken them up on that, which has now put $400 million into Tesla's pocket, well before they have had to ship even their first car. Innovation is everywhere. Okay, so with all that said, can corporate finance include innovation in its thinking? And there's 3 steps. The first of all is just we need to acknowledge its importance, right? Without corporate finance, we're guaranteed, your MBA will tell you that we're guaranteed to follow the S-curve into oblivion. So we need to make sure that we understand, as difficult as it is to think about and to quantify, we need to understand that innovation is critical. The second thing is we need to find ways now, models, to assess innovation projects beyond a simple, 0 or infinity. It's going to fail or it's going to succeed wildly, but I have no way of knowing, how to assess, which of those it's going to be. And so we want to figure out ways to do that. And one of the ways is to bundle a number of projects up, like a little bit like 3M Company has done. We're going to allocate a budget of 5% or 6%. We know we're going to have winners. We know we're going to have losers, but we know that at the end of the day, we have a culture of innovation. And so as long as we learn something from our losers, that will allow us to get better the next time. And I'm sure they have an internal, highly iterative process that allows their R&D. It isn't just making a big bet, go away for 5 years and come back with a big product and we'll see whether it works. I'm sure that they've got this incremental approach applied to this incrementalism now applied to innovation. So that's, again, how corporate finance is going to take your strengths of incrementalism and analysis and apply that into innovation. The third way is to then embed these approaches into the culture of your corporate finance team and practice them relentlessly, as Apple does, as 3M does, as a lot of these successful, they look like tech companies. Some of them aren't tech companies, though. There are companies out there that are like 3M that aren't tech companies, and yet they're highly innovative in their thinking. And the corporate finance team is absolutely a big part of that, or is managing a part of that process. And then the bonus step, of course, is to have fun doing whatever you're doing. If you're doing corporate finance, which doesn't necessarily have the reputation of being the most fun topic, but I think you can find, that's your challenge, is to make sure that you are having fun in corporate finance, because there you can see that, I hope by these examples, that corporate finance can be a very, very exciting place to be and drives the success of companies forward. So with that, I don't have a clock. I can't see my time. I hope that I'm not over time too much. And thank you for your attention. I'll turn the camera on so I can see you. And if you've got any questions, just stick up your hand, and I'd love to. Yeah, I'd love to hear from you.
Alex, that was a great presentation. Appreciate it. I hope the class got the essence of that, because innovation is really the key. However, the examples that you gave are largely large corporations, Fortune 500 companies.
Yep.
How well does this concept work? And I'm imagining that you deal a lot with small to medium-sized businesses, where basically they're dealing with day-to-day nitty-gritty, a smaller, much larger margin of error that they have to deal with to ensure that they continue in their business. How easily is this tied and embedded in smaller organizations like that?
Well, that's a great question, and you're right. These ideas have been selected because of because everyone kind of knows them and can relate to them, and you can find data, and you know that from teaching these courses. But you're right. The corporate finance is actually at the heart of every entrepreneurial venture, except that we often don't think about it. Entrepreneurs, by their nature, are often much less sophisticated than people coming out of their MBAs. I mean, I had started and successfully sold my first 2 companies, and I had no schooling, and then I went and got my MBA. And so what I intuitively tried to understand was that I needed to understand the fundamentals, first of all, of finance, of cash flows, and second of all, I needed to understand the essence of investments. That in fact, when I spent money on marketing, when I spent money on sales, when I hired a salesperson, when I spent money on product development and support, all those pieces, that wasn't just an expense, that I needed to do that in order to keep my company going. Those were actually investments. And what I encourage, the business owners that I work with, and in my writing, and I'm doing an article on this right now, which will be released next week, but what I encourage people to do is to change their thinking from this top-down approach, from I get some money and then I spend money. That's what I'm doing. I just expense money until I have a bottom line, and I judge my performance based on a bottom line. What I try to get people to do is to think about gross margin. First of all, many small companies don't have a bottom line worth to speak of. They have losses, not profits. So what I try to get them to do is to think about gross margin. And when you think about gross margin and increasing gross margin, it means that you look at your expenses below that as investments. If I'm going to spend money on sales, I'm going to spend money on marketing, those things better have a return on investment that then jumps up and is seen in revenue and then flows into gross margin. So does that help to answer that particular question, Dr. Dorset?
Yes, it does. Thank you.
Yeah, you're welcome.
Any questions? Come on.
So tell me a little bit, if there's no questions, let me ask the class a question, and just for a couple of minutes. So are you all California based, or have some of you come from other parts of the U.S. or other parts of the world? Give me a sense of who's in the class and where you came from.
From India.
India.
Yeah.
Awesome. Who else?
Philippines.
Oh, Philippines. Awesome.
From China.
From China. This is amazing. What else? Where else?
California.
California. Yay. Yeah. Well, that's great. I mean, and this is the, I see this all the time. And in fact, on this call right now, we got another dozen people. And I know for a fact that at least one of them is from New Zealand. They're from all over the world. These things that you're learning in this class, this team that you've put together, working with your prof, this internationalization is critical to business. And it's awesome. I never walk into a class anymore. I never walk into a team without seeing this huge internationalization. I absolutely love it.
Do you find that the concepts of innovation are pretty much well understood around the world, the way you presented them?
Well, I think certainly the concept of innovation is in terms of, I think we intuitively realize that we have to create something new in order to be able to compete, right? What I've tried to do is I've tried to help quantify that in a way that it gets people to really put it at the top of their head. What's happening in the last 25 years, as you know, and increasingly in the last 10 years, is that the pace of innovation is increasing. What's happening is that as each new layer of innovation comes along, the innovation itself is then used to accelerate the next and the next and the next pace of innovation. And so what used to take 25 years or 50 years in order to, we went from one industry and then it was replaced by another industry. What we're now starting to see are companies like YouTube. I mean, YouTube is under threat right now. Its business model is under threat, and it's only 12 or 13 years old, right? So yes, everyone kind of gets it at some place, at some visceral place. But what I'm trying to do, and what I appreciate, the ability to come into your class and try to do, is to try to quantify that in a way that people put innovation first and foremost, and they embed it into their corporate finance class. They embed it into their strategic thinking. They walk around every day looking at their products and their services and thinking, how can I make this not just incrementally better? How can I make this fundamentally, foundationally different, a different experience for my customers and my clients? That's the road to success.
Exactly. Any questions? Do you have any more questions for the class?
No, I just again, I just want to express my appreciation to you and Rob and everyone in the class here. I know you've got some students online, and there are other people that are watching online. Just thank you all for giving me this opportunity to visit with you in Southern California, and I want to wish you good luck with your course and your MBA and the businesses that you go out there and are involved in running. So congratulations to all of you.
Thank you, and we really appreciate the subject matter because it's appropriate. Hopefully, we always look at the students as potential entrepreneurs, and innovation is, as you say, it should be up here at the top where whatever they start, they have to recognize it has to be ongoing and continuous.
Absolutely.
So we appreciate your time, and hopefully we can have you back again.
I would love to come back anytime. All right. Thanks, Dr. Dorsett and class, and we'll see you again.
We'll see you.